Hello, Business 630 students. This is Professor Hassey, and it's our Week 3 update video. Today's date is Saturday, June 24th, and we are working on our first case study this weekend, due tomorrow, Sunday, June 25th. There are extensions available if you need some extra time, but that video that is due this week, a risk analysis. We're also concluding our discussion about capital fundraising, stocks and bonds, heading into our next couple of weeks talking about capital budgeting and the cost of capital budgeting analysis, of which you'll have case number 2 to do. Now, case number 2 is a little bit different. It's a spreadsheet case where I give you the spreadsheet and you work on that template. Secondly, the case is posted Monday, June 26th, but you have 2 weeks to do it. It is due Sunday, July 9th. So 2 weeks to do case number 2, and we'll talk more about that as we get into week number 4. Remember, we are working on case number 1 this week, which is a qualitative and quantitative risk analysis of a company that you have selected. I'm looking forward to reading all this in the beginning of next week. It's an APA formatted paper. There's a sample paper or a sample format provided, and you are to do 2 basic analysis of the risk of a company. First of all, the quantitative analysis of determining the credit rating. You already have determined the beta, determining the cost or the required return on equity or the cost of equity by using the beta, a risk-free rate of 3.75, a market risk return of 8.75, and the cap, and then to determine the weighted average cost of capital of the company by determining the capital structure percentages of debt and equity as of the most recent financial quarter, which is probably March 31st for your company, and then to determine the weighted average cost of capital using the required return on investment from your capital asset pricing model calculation, and then determining the after-tax cost of debt, which is 8%, and a tax rate of 25%. That's a quantitative review of your company. Numbers. Then you get to a qualitative review of your company, taking a look at the organizational and environmental risk of your firm. Put those together and you have a pretty good assessment of the risk, high risk, low risk, what type of risk your company has that you've selected. And that's what we're looking at in case number 1.
In week number 2, we had an article from the Harvard Business Review to review and to read, which set us up for week 3 in our discussion of capital asset pricing model. Remember, in case study number 1, you are to take the company that you have selected and take a look and determine their credit rating, either Moody's or S&P credit rating, and then to determine, and by locating the beta of the company and determining the return on equity or the cost of equity using the capital asset pricing model. This article in the Harvard Business Review sets up that analysis, whether it is good or bad in determining the risk and value of a company. It defines the capital asset pricing model. It takes a look at alternative ways of looking at risk analysis for companies. And this is one of the key parts of case number 1. You are doing a quantitative review of the company using the capital asset pricing model, determining the credit rating, looking at their capital structure and the weight of the capital structure to determine the weighted average cost of capital. In addition, you're doing a qualitative review of a company, the environmental analysis of how the company sits in their markets and how that determines the risk of the business. Looking at the governance of the company, the management. Is there quality or no quality in how the company is managed? All these play a quantitative review versus a qualitative review of a company. And that's the theme of case number 1, is to do those types of analysis to review the business that you selected. To get some ideas on how to go about this article is a good review, a good research for going about that case number 1 analysis. So if you have not read it yet, do so this weekend. It'll be might be a final piece of the puzzle to look at the risk analysis interpretation of your company. Efficient, chaotic, what's the new finance? The article from Harvard Business Review. You remember from our prior weeks, we have a spreadsheet that's posted both in week 2 and week 3 Blackboard file folders that explains the definition of capital asset pricing model and risk management for a company. If you remember this spreadsheet, and you can download it to review it if you have not already done so, there's a tab entitled Chapter 6, which goes over the risk and return concept of the capital asset pricing model, taking a look at the company's beta, taking a look at the risk-free interest rate, which is the 10-year United States Treasury yield with a zero risk beta, and taking a look at the expected market return of the average return in the overall United States stock market with a beta of 1, and in this example, it's 10%. Taking those key rates, the beta of the company, 0.8, the risk-free interest rate, and the expected market return, you can determine the expected return that investors, based on the risk of this particular company, would require as an adequate return on this investment. In other words, the cost of equity, 8.67%. You are asked to do this in case number 1 for your specific company. Then we went to the next week, we talked about the time value of money concept and how money can be discounted or determined the present value over time. In this example, in this tab of the spreadsheet, where we took an investment of $100,000 and found that the investment was going to generate after tax cash flow of $140,000 over its depreciable life of 10 years. With a cost of capital or a cost of money of being 6%, that investment proved not worthy. In other words, the actual return of the investment over time was 5.33%, or a negative net present value of almost $3,900. In other words, the cost of money over those 10 years was not sufficient enough to over the cash flow being generated by the business. And this holds true in any investment in assets like bonds or stocks, that their discounted value needs to be above the original amount of the investment. And then we took a look at that in Chapter 5, specifically to bonds, fixed income investments, where bonds are based on the coupon rate that the lender pays the investors in the bond. And if rates change in the markets, the value of that bond investment goes up or down, either a premium or a discount, depending how the yield to maturity reacts to the original coupon rate. And then we took a final look at that this week in regards to stocks, looking at the constant growth rate stock valuation of a stock, taking a look at its dividend to be paid out in the future over the growth rate of the company versus the expected return of the investors. That can determine the intrinsic value of a stock over time. As you can see in this example in the spreadsheet from Chapter 7, if we take the dividend of the current year, $1.50, and divide it by the difference between the expected return of 13% and the growth rate of the company of 6%, we get an intrinsic value of the stock at being $21.43. That $21.43 indicates that's what the true value of this stock based on their expected payout rate of dividend versus the cost of the money and the expected return of the company. Many investors use this as a mark of determining whether to buy or sell a stock. Also, that leads us into the discussion, where did that 13% expected return comes from? That's the capital asset pricing model, which is used to determine that expected rate of return. All this plays into the determination of how a company is risk-oriented in the market. And that's the subject of case number 1 this week. You are to do that analysis of your particular company. Are they risky or are they not? Are they risky quantitatively? Are they risky qualitatively? That's your analysis of your company in this week's case. The first third of the course now completed, we've now taken a look at understanding the risk management of a company and how to look at it. Now we move into the second third of our course, beginning in week 4, where we take a look at capital budget analysis. Now that we have raised our capital, where do we invest it? Do we invest it in new markets overseas? Do we invest it in markets at home to develop new products, new strategic goals, and how we set up our business model? Or where do we go to next to generate growing intrinsic value of the equity of our business so our shareholders get an adequate return? So that's what week 4 is all about. You'll be given a case in this week 4, case number 2, which is to actually calculate a capital budget analysis. Now you have 2 weeks to do this case. It is not due next Sunday, it's due in 2 Sundays from this weekend. And the reason for that is many of our students in this class have not studied this recently. Some have not. So it's going to take another week or so to get up to speed, and we'll be doing some practice templates of this analysis during our week number 4 lectures. But first of all, what is a capital budget analysis? It's to determine the return on an invested amount of assets over the projected life of those assets, which is, in the case of all of financial study, it's the depreciable life of those assets. In order to calculate this, you need to determine the weighted average cost of capital, which we did in week number 3. Weighted average cost of capital is your discount rate to take the cash flows that you will be generating off this investment to determine its true net present value. So in week number 4, we're taking a look at this analysis. There's a good PowerPoint which defines weighted average cost of capital in this perspective. There's a review of the definition of the steps to determine weighted average cost of capital, but you already know how to do that from week number 3. And then there's some great PowerPoints from each of our individual chapters that define the process of determining capital budgeting. And we will be practicing this week, some of these examples this week in week. An adequate return to our investors before we even spend the money and acquire those assets. That's a key part of financial management and financial analysis for a company. But before we get to this in week 4, and the video will be posted on Monday of this coming week, let's finish up case number 1. Remember, extensions are available should you require some extra time to complete that work. Remember, this is an APA formatted paper, which is double spaced, which has a title page, an abstract page, a reference page in addition to your analysis. Any questions, please let me know over the weekend. Have a great weekend, everybody, and we'll see you in our lecture video for week 4 at the beginning of the coming week. Have a great weekend. Bye-bye.